Alright, class. So today we're going to be starting chapter on basics of capital budgeting. Alright, this is one of the important chapter. Alright, as you can see on the slide, there's an image of a factory or plant, and here the guy is asking a question: should we build this plant? Alright. So in this chapter, you're going to learn the techniques which, at the end of the day, will give you a guidance, will give you a advise whether to go ahead with the project or should we reject the entire plan, right? So let's begin with understanding what is capital budgeting. All right, so capital refers to the long-term asset used in the production. All right, long-term assets. We are not talking about working capital, right? Working capital is for the short term, while this capital budgeting we are referring to a long-term assets. For example, a factory, a building, building a mall, right? That kind of thing. And then you have budgeting. Budgeting is a plan that outlines projected expenditure during some future period. All right. So when it's a long-term assets, you're planning to use the assets for a longer term. It could be for 10 years. It could be for 20 years. So if that's the case, you need to outline a plan which projects the expenses. All right, for the expenses. Let's say you're planning to build a mall. All right, so you need to know what are the expenses going to be incurred to build the mall, and later on how much income you can able to generate by having the assets. All right. Capital budgeting is a whole process of analyzing projects and deciding which ones to include in the capital budget. All right. In the whole process, you'll be learning the relevant expenditures and the relevant income. All right. Which one you need to include in the capital budgeting. All right. Which expenses and which expenses you might not include that in the capital budgeting. All right. So this you might have learned the entire chapter before. All right. The techniques like net present value, internal rate of return, payback period, discounted payback period. All right. So all those techniques will be used to analyze a project, whether the project will be viable to the company or not. So let's go to the next slide. Firms generally categorize projects differently. Alright, so capital budgeting can be used for different purposes for the company. For example, you have a capital budgeting for the purpose of replacement. Alright, as you can see, the first and second point is replacement, but for the different reasons. The first one is needed to continue the current operation. Alright, let's say you are having a factory for the last 10 years, and now after 10 years, the machines are already outdated. So, let's say worn out, that you need to replace the machineries so that you can continue your operation. All right. So the first purpose is you are having this long-term assets in order to continue your current operations. All right. The second point is also for the purpose of replacement, but the reason, the purpose is because you want to reduce the cost. All right. Let's say you're having a factory where it's like the machineries are old and it's consuming too much of energy and time. So now you are you're having a you're replacing the old machineries with a cutting edge machinery where you can reduce the resources, the energy consumption, all right, and more efficient. So that is the second reason. You're replacing so that you want to reduce the cost. All right. The third reason is expansion of existing products or market. All right. So the third reason is you want to increase your existing production. All right. Maybe by 50%. All right. So you could expand your existing product. Let's say you are producing 50,000 units per month. Now you want to expand it, make it 75,000 units per month. So you might need to buy more machineries, more equipments, all right, more assets in order to expand. Or you can also expand your market. All right, let's say you are only all this while you're only focusing on the local market, let's say just in Malaysia. Now you want to expand it to overseas. All right, let's say Singapore, Thailand, Vietnam, and so on. All right, so that could be the third reason why you want to purchase an asset, because you want to expand your existing product or market. And the fourth reason would be expansion of new products or market. All right, so this is the existing product, the third one. The fourth one would be new products. All right, let's say a company is only selling, um, let's say, orange juice. All right, now they come out with a, let's say, a lemon juice new product. Okay, and then the fifth one is for the safety or environmental projects. So you're required to purchase an asset, required to build an asset in order for the safety, all right, or environmental project. You see, sometimes companies, manufacturing companies, they have a lot of uh, they have a lot of pollutants, right? So they need to have certain assets in order to uh, reduce the pollution, all right? And of course, you have other projects, all right? So different depends on every companies. So they can have certain assets for their current operation, all right? So class usually we will have like we have questions more on question 3 or question 4, right? Relevant to question 3, point 3 or point 4, right? They have a new product, and we need to calculate and compute techniques to see whether the new projects or the new product is viable or not. Okay. All right. So class, this is the steps to capital budgeting. All right. So the first steps is you need to estimate the cash flows. All right. So by estimating cash flow means you need to know how much is the inflows and outflows going to be. Inflow means the income generated from having the project. All right. So having a new long-term asset, and then outflows is the expenses. What are the costs and expenses? So the first thing is you need to estimate the cash flows. If let's say your project is going to be for the next 5 years, so you need to estimate the cash flows. And then you have to assess the riskiness of the cash flows. All right, how risk is the cash flow? If it's risky, then you might need to determine the appropriate cost of capital. All right. Once you know the appropriate cost of capital, then you will calculate your NPV or IRR. All right. So what is the rule? If the NPV is more than zero or NPV is positive, then you will accept the project. And for IRR, if the IRR is more than WACC, then you will accept the project as well. All right. If it's less than WACC or the cost of capital, you will reject the proposal. Right. So these are the steps when it comes to capital budgeting. So what is the difference between independent and mutually exclusive projects? All right, so let's see the independent projects. All right, so independent projects are the cash flows are not affected by the acceptance of other projects. All right, so you have project A and project B. If you choose project A, you can also choose project B. All right, because A is independent to B. All right, so that is independent projects. Mutually exclusive projects means if you have two projects A and B, if you choose A, then you have to reject B. All right, if you choose B, then you have to reject A. You can only choose one. That is called mutually exclusive. All right, mutual means together, exclusive means you cannot have two together. All right. All right, then you have normal cash flows and non-normal cash flows. All right. So normal cash flow streams usually have the cost in the beginning of the project. All right. Then it continues by series of positive cash inflows. All right. It's just one change of signs, which means the beginning of the project you need to spend, all right, resources and funds so that you start the project. It could be like um, buying a new machinery. So you need to spend your money. So that is a net outflow, negative cash flow. So after that, second year onwards, all right, you will have inflows, the income generated. So that is a positive sign. The non-normal cash flow stream or abnormal cash flow stream happens when the beginning of the project you have a negative cash flow, all right, then followed by positive cash flows. But at the end of the project, you have another negative sign, a negative cash flow. All right. This usually happens projects that you need to spend some money in order to um, end the project or complete the project. See, for example, nuclear power plant. All right. When you start, of course, you need to spend money to build the entire nuclear power plant. Once it's after use for let's say 20 years, at the end of the 20th year, you will still spend some money in order to clear the entire area so that it doesn't have any environmental damages. All right. So here you have cash outflow in the beginning and also end of the project. All right. So that is why you have a normal cash flow where only one change of sign. In non-normal cash flows, you have more than one. All right. All right. So let's start with net present value. All right. So net present value class is one of the most important techniques in order to evaluate viability or worthiness of a project. All right. So if you compare to other techniques that you're going to learn later, this is the most important. All right, because this this technique, net present value, at the end of the day will tell you exactly how much surplus, how much excess you're making. All right, if you have the project. Okay. So NPV tells how much a project contributes to the shareholders' wealth. All right. So if you're calculating for a project, and let's say at the end of the day your NPV is 500,000, that means your company's wealth, all right, or shareholders' wealth will increase by 500,000. All right. So that's how granular the way you calculate the return. All right. The larger the NPV, the more value the project adds, and added value means higher stock price. Thus, NPV is the best selection criterion. All right. So once you get the results, you will know exactly how much the projects giving value to the company. All right. So higher the NPV, it means higher the value of the project. That will end up reflect in your share price, right? So higher the project NPV, that will reflect the success of the project, and it will reflect in your share price, right? So how to obtain the cash flow? All right. First, the cash flows has to be adjusted to reflect depreciation, taxes, and salvage value. All right. So depreciation is basically you want to value how much asset value reduces every year. All right. If you buy a car in the beginning of the year, let's say worth 100,000, you use it for 5 years. All right. Do you think the value will remain the same? All right. Definitely the value going to depreciate, value going to reduce. So how are you going to uh, account when the value drops? Let's say in the beginning it worth 100,000, end of the fifth year it's only worth 20,000. So how are you going to account the loss it incurred? All right, there's a loss of 80,000, right? So you need to charge it somewhere in your financial statement. So that is why you depreciate. So that in each year you might reduce the value based on, we have a calculation. All right, we're going to be using straight line method. All right, so that is depreciation accounting estimation to in order to account the value reduction of your asset. And then you have taxes. All right, depends on whatever the question gives you. Profit before tax minus tax, you're going to get profit after tax. And then you have salvage value. All right, so salvage value is when you purchase an asset, let's say worth 50,000, and you're using for 3 years. After end of the third year, let's say the project ends, and you are selling the asset. All right, let's say you purchase it for 50,000. After using the project, the asset. Okay, so after you use the asset for 3 years, the asset, let's say, you still got some value, and you dispose the asset. Let's say it gives you 20,000. All right, you purchase for 50,000, and after project you dispose the asset. At that moment it's worth 20,000. 20,000 is your salvage value. All right, you might heard scrap value or disposal value. It's a similar thing. All right, so whatever you bought in the beginning, at the end of the project, if you still has some value, if you sell it, if you get something gain from disposal, that's your salvage value. All right, so of course, if let's say the asset uh, in the beginning worth 50,000, another project it doesn't worth anything, then your salvage value is zero, right? All right, the second point would be the present value of each cash flow is calculated, discounted at the project's risk-adjusted cost of capital. All right, so the present value of each cash flow is calculated and then discounted at the project's risk-adjusted cost of capital. It means once you calculate your cash flow, all right, we're going to look at the examples later on. Every year you want to calculate what is the cash inflows, what is the cash outflows, right? Once you calculate every year, all right, then you have to discount it in order to calculate the present value. See, that's the whole idea of net present value. All right, if I'm going to get 100,000 end of the first year, I need to calculate and see how much is it worth today. All right, that is net present value. Whatever you getting in future, you want to calculate and see how much is worth today. All right, that is NPV, and that will be adjusted based on cost of capital. Okay, risk adjusted. You need to adjust your cost of capital based on the risk averse. of the company. All right, how are you risk averse? Are you risk taker? So based on that, your cost of capital adjusted. That cost of capital will be used as a discount rate to calculate your present value. And then the sum of discounted cash flows is defined as the project's NPV. All right. Every year's end of the years, once you calculate the cash flows, the discounted cash flow, which means, in other words, discounted cash flow, in other words, is the present value. All right. So if you add all the present value of each year, that will give you the project's NPV, net present value. All right. Then the net present value, based on that, you can decide whether you're going to continue the project, or you can uh, or we can just reject the project. If your NPV is positive, you reject the project. Nothing to think about, right? When it's positive, then you can go ahead with the project. All right. So net present value. Okay. So this is the sign which equals to sum. All right. You calculate the years. All right, and it's the number of the period. All right. So sum of PVs of all cash flows, inflows and outflows of a project. So whatever the cash flows, 1 plus r power of 3 is the discount rate. All right. So this is your cash flow. All right. Your cost of capital and the duration of the project's life. All right. So let's do an example to get a clear understanding of NPV. All right. So you have two projects here, project L, project S. Each has the same cash outflow in the beginning of the year. Plus, when we say beginning of the year, it means year zero. All right. Let's say 1st January 2020, that is year zero, right? And then 31st December 2020, that is year one, right? From here to here, that's 1 year. All right. So first, remember, year one is 31st December 2020, or we can also look at it as 1st January 2021. Okay. So year zero is the beginning of the year one is the end of the year. All right, after 12 months period. Then the following 12 months, 12 months. So year one, year two, year three. So if a project, if they say the project duration is 3 years, then you have 4 rows, right? Year zero, year one, year two, year three, right? You always start with year zero, that's your cash outflow. Then you have cash inflow, inflow, inflow. All right. So you have two examples. So the question telling you have initial investment, all right, and your cost of capital is 10%. Then you're required to calculate the NPV of the project and decide which one you're going to which uh, which of these projects you're going to accept, right? So let's calculate. For project L, you have, in the beginning of the year, you have negative 100. All right. So your PV is the same, because year zero means now. $100 today is worth $100, right? 100 ringgit. You receive, let's say, 10 in year one, and you need to calculate the PV, right? So how are you going to calculate the PV? In between, you have the discount rate. All right. So class, here you're going to add a discount rate. All right. Discount rate at 10%. All right. So discount rate at 10% will give you first year one. Year 01, year one 0.909, year two is 0.826, and year three is 0.751. All right. So once you have the discount rate, cash flow times the discount rate, you get PV. All right. So 10 times 0.909, you get 9.09. 60 times 0.826, you got 49.59. 80 times 0.751, you get 60.11. So when you add up all this together, you get 18.79. All right, so that is your answer. If you look at the project L as independently, would you accept the project? Yes, you would, right? Because your project gives you positive NPV, therefore you will accept the project. So class, why don't you calculate for your project S? All right, same method. You have number of years, your cash flows. All right, based on what is given in the question. Then you calculate with the discount rate. Cash flow times discount rate, you got present value. Add up all together, you'll be getting your NPV. All right. So class, you can calculate and you can find out that your answer would be around 19.98. All right. And if some of you use calculator, and you might be getting 21.18, right? As I said, if you use a PV table, if you use a calculator, the answer might be slightly different. All right. So you calculate and find out for project L. So if this is the case, when you compare two projects, we can tell that project S gives you a higher NPV, therefore you can accept project S. It is mutually exclusive. All right. It's a mutually exclusive. You have to choose one. You choose S, higher NPV. Or if it's independent, then you can choose both the projects, right? Because it has both has a positive NPV. So moving on. So inflows minus the cost, that is your NPV, and that is net gain in wealth. All right. So if positive means it's net gain, negative means it's a net loss in the company's wealth or shareholders' wealth, right? So independent, you can accept both the projects because both are positive. Mutually exclusive, we choose the highest. All right. So accept S seen as a higher NPV. So let's move on to the next slide where we see the strength and weakness of NPV. All right, so what are the strengths? NPV gives importance to time value of money, profitability and risk, maximizing the firm's value. And let's look at the weakness. All right, so before we go into the weakness, let's look in detail what we're talking about now. Strength, right? Time value of money. All right, so the first strength is time value of money, which means, as we learned in the previous chapters, you need to calculate how much future value worth today. All right. So if I give you 50,000 in 5 years from now, all right, how much is it worth today? You need to calculate the time value of money. Then you know the 50,000 in 5 years from now, today might be only worth 40,000. All right. So NPV calculates time value of money. So that is good. That's a strength. It also includes the profitability, how much overall profit the company is making, and what was the risk the company is uh, taking. All right, so that is important when you're calculating NPV. NPV helps in maximizing firm's value, and it tells you how much the company's wealth will be improved. All right, so if you're let's say your company is worth 100 million. Now you're doing a project, and the project, let's say you calculate and you get the project's NPV is 5 million. So from 100 million, now your company will worth 105 million. All right. So it directly reflects the company's worth. So that's a good thing about NPV. All right. Okay. So those are the strengths. Let's see the weaknesses. It requires an estimate of cost of capital in order to calculate. All right. So the first thing is you need to make an estimation. What is the cost of capital? What is the suitable cost of capital for the company? All right. So how do you determine the cost of capital? All right. So cost of capital is another chapter we're going to learn. All right. So where you need to find the financing cost for the debt, financing cost for the equity, then you have to add up together based on the probability. All right. So usually the questions, all right, usually questions to provide cost of capital unless they require, they give you information in order to calculate it. All right. And of course, it includes some assessment of riskiness as well. All right. So that is not straightforward. I mean, in real life. All right. In questions, it might be given. All right. And express on terms of ringgit. Like I say, if you are doing a project, you calculate NPV and you get 5 million NPV. It means your project gives you surplus of 5 million ringgit. All right. You, okay, you might think why is a weakness? All right. There's a weakness because when it comes to corporates, the directors, the higher level managers, they might prefer to look at percentage. All right. If I do the project, what is the profit? What is the return I'm getting? So they prefer to, if you tell 15 point 15.5%, all right, or this project give me 20% return. So they prefer that compared to giving them value in ringgit. Okay, so that is a weakness of NPV. All right, so moving on for the next um technique in capital budgeting, which is internal rate of return, IRR. Right? It defined as the discount rate which, when applied to the cash flows of a project, it produces the net present value, right, of nil. All right. So it means previously when we learned NPV, we learned that we require cost of capital in order to calculate the question, and usually it's provided in the question. Let's say if you use IRR rate, all right, let's say you already know the IRR rate. Let's say use IRR rate as your cost of capital. All right. If you use IRR rate, you replace with cost of capital. If you use IRR as your cost of capital, your NPV will be zero. All right. Your NPV will be zero, which means you don't make profit, neither loss. So that is the meaning when your NPV is zero. All right. In other words, IRR will let you know how much is the return you earn from the projects, all right, from the project in terms of percentage, all right. So that is internal rate of return. So how do you calculate internal rate of return? All right. So class, RA is the lower discount rate chosen. RB is the higher discount rate chosen. All right. So why there is two discount rate? It's because, for you to calculate IRR, you require two NPVs. Right? So remember, you need to calculate two NPVs for the same question. All right. For the same question, you need to calculate two NPVs, and you require to produce one positive NPV, another one with a negative NPV. All right. So remember, it's the same question, but you have to calculate two NPVs. One is positive, another one is negative. All right. Why do you need that? Because you need those information in order to calculate your IRR. All right. So let's say in a question they give you the information and they say the cost of capital is 10%. All right. With the 10%, let's say you have calculated the NPV, and then let's say you got a positive NPV, right? So with 10%, you got a positive NPV. Now you need to calculate another NPV which gives you negative return, right? So what you will do is you will make an assumption of the cost of capital and you want to make a negative NPV. So what will you do is you increase your cost of capital from 10%. Let's say you try another uh, computation using 20% discount rate. All right, previously you used 10%, you get positive. Now you try 20%, and then with that, if you get negative, that's it. Now you can go ahead to calculate IRR. But let's say you calculate 20% discount rate, but yet still you get positive NPV, then you require to calculate another NPV, right? So that's how it works. So if you use 30% discount rate and if you get negative, that's it. Now you can move into calculating IRR. All right, so let's say we assume in a question 10%, all right, you get a positive NPV. By using 20%, you get negative NPV. So here, RA stands for lower discount rate chosen. All right, so lower discount rate, remember, we had 10 and 20, right? So RA is the 10% lower discount rate. So 10% plus NPV from lower discount rate, which is the positive NPV, and then divide by positive NPV minus the negative NPV and NPV from lower discount rate. All right, see, positive minus negative NPV, which means what? Minus negative, it becomes two negative signs, right? When you have two negative signs, it becomes, yes, you guessed it right, it's a positive, right? Then NPVA will end up adding NPVB. All right, so that is the whole idea why we require to get a negative NPV because of the formula itself. Because you have negative, only when you have negative NPV it becomes positive. Then you can move ahead with your calculation. Then you have higher discount rate minus the lower discount rate. So with that, you can able to calculate or compute IRR. So the rationale of using IRR, right, which means how you're gonna determine whether you're gonna accept or reject the project is based on your result. If your IRR more than WACC, all right, if your IRR more than WACC, you accept the project, all right. If your return is more than your cost, you accept, right? If your return is less than your cost, all right, if your return less than cost means, let's say your return is 10%, but your cost is 15%, will you still accept the project? No, right? Therefore, you will reject the project. If projects are independent, all right, you will accept both the project. If projects are mutually exclusive, you accept as. All right, so you're looking at, we will be looking at an example. All right, we are calculating the same, uh, we are using the same example for the previous question, and if we compute, all right, when we compute, we'll be getting, if we compute, we'll be getting 10%, right? If projects are mutually exclusive, accept S because IRR is more than IRR, right? So, okay, later on we'll be doing examples so that we can understand how the IRR and the decision from the IRR works, right? All right, so let's look at the reinvestment rate assumptions. NPV method assumes cash flows are reinvested at the WACC, while IRR method assumes cash flows are reinvested at IRR, right? So you have see, when it comes to a lot of financing techniques, models, it comes with a lot of assumptions, right? So for NPV, the assumption is your cash flows are reinvested at WACC. Okay, what is reinvested? Let's say you have a project for next 5 years. First year you earn 50,000. Second you earn another 50,000. The 50,000 you earn in the first year, you won't just keep it in the bank balance, right? What do? You would use the money, take the 50,000 and reinvest at the beginning of year two. All right, you might put it in a fixed deposit or find another project, you invest on that. Even though your project ending in fifth year, you will, whatever you earn in year one, you will reinvest until end of the project. All right, so the reinvestment assumption is you assume your return is the same as your cost of capital. While for your IRR, your reinvestment rate is IRR itself, which means if you calculate and you get IRR, let's say 20%, so it assumes you're reinvesting year one cash flow at the IRR rate, year two at the IRR rate. All right, so you have two different assumptions here. So here, assuming reinvesting at the cost of capital, which is the opportunity cost of capital, all right, your WACC is more realistic, right? Usually your cost of capital will be 8%, 10%, all right, if you which is more realistic compared to IRR. IRR assumption is sometimes is not practical because if let's say your IRR is 40%, all right, this is possible. If your IRR is 40%, can you assume you can reinvest whatever you earn in first year at a 40% return? All right, so highly unlikely. So that is why NPV method will be uh, preferable, all right, compared to IRR because of this assumption. All right, so let's look at the strength and weakness of IRR. The good thing about IRR is easily understood, all right, by managers because if you just tell them the return is 10%, all right, from the project, your return is 10%, is easily understood compared to giving them NPV. All right, if you're giving them NPV, then they will ask, okay, what was their yearly uh, early present value and what is their beginning, what's the cost they incurred and so on. But if you give IRR is 10%, then they know, okay, overall they earn 10%. Okay, it's a discounted cash flow method as well, therefore it considers time value of money. It considers cash flow throughout the life of the project. All right, so that is also good. And a relative measure in form of percentage. All right, so it's a good thing is you can compare with your cost of capital. All right, if your IRR is 15%, your cost of capital is 8%, then you know your IRR, your return is more than your cost. All right, so it's one of the easy way to evaluate the project. So the weakness would be ignores relative sizes of the investment. Whether you're doing 100 ringgit worth of projects or 1 million worth of project, all right, it ignores the size of the investment. Let's say 100 ringgit worth of project gives you 20% IRR and 1 million worth of project give you 10% IRR. Which one will you choose? You will choose the higher IRR. But you ignore a 1 million project for a 100 ringgit project, right? So that is the weakness. May produce more than one IRR. All right, so that's difficult when it comes to decision making. So that is another weakness of IRR because you might not get only one result, you might get more than one. All right, so that can be confusing when it comes to decision making. So those are the weakness. All right, so with that, we can move on to the payback period. All right, so plus payback period, you could say the one of the simplest techniques in your capital budgeting. The number of years required to recover a project's costs. All right, let's say you spend 50,000, all right, in order to purchase an asset. How long it took for you to recover the 50,000? That is payback period. How fast? How long does it take to get your money back? So that is payback period. Calculated by adding project's cash inflows to its costs until the cumulative cash flow of the project turns positive. All right. So you calculate all the cash inflows, then you start deducting your costs one by one so that you found which at the exact point of time where you can recover all your costs. So that is a exact point, or that is a period you'll call it at payback period. All right, how fast you recover your money. So as you see in this example here, all right, so this is the early example, project L, project S. At the beginning of the year is 100 negative, all right, it's outflow. Then you have 10, 60, 80. So our whole idea is how fast, how soon you recover the cash outflow, right? So in the beginning, in the first year you recovered 10, therefore you have remaining 90. Year 2 you recovered 60, therefore you have remaining 30. When did you recover the 30? In year 3. All right. So now you want to calculate in which exact point of time you have recovered the amount of your cost of your initial investment. So it took full 2 years, 1 year, 2 years. It took full 2 years and 0.375 years. Okay, how do you get 0.375? You have to recover 30. All right, in year 3 you have to recover another remaining 30 out of the total amount in year 3. So 30 divided by 80, you get 0.375. So you took full 2 years plus 0.375 years. So basically this 2 plus 0.375, you get 2.375 years. All right. So you didn't recover in year 1, year 2. You only recovered in year 3. But when exactly in year 3? All right, not end of the year 3, right? It's somewhere in between. So that is why you have to calculate the exact point of point in time. All right. So if you want to know exact month, what you could do is 0.375 times with 12, you will get exact month, right? And for your company S, all right, so class, you can just calculate the same way, all right? This is called timeline. All right, you do this is the number of periods, this is the cash flow, so you can draw like this, and then you have cumulative, right? This this exactly the same, so this plus this is the cumulative, this plus this, all right? So using the same way, you can able to calculate your payback for S as well. All right, let's look at the strengths and weaknesses of the payback. All right, the strength it provides an indication of project's risk and liquidity. All right, what's the risk and liquidity? Okay, the first thing, if your payback is very long, all right, let's say your project is 6 years and your payback period is 5 years. It means it took 5 whole years to recover your initial investment. All right, only after that you are making some profit. So that is kind of a risky, right? So you always want to recover the initial investment, your costs, much earlier, so that the remaining point of time you can reinvest the initial investment into other projects. All right, and it gives you some kind of certainty that you recover the money earlier, so that the rest of the period would be for you to make profit, right? And other strengths are easy to calculate and understand. So you just, it's basically how fast I recover my initial investment. So it's easy to calculate and also to understand. The weakness, of course, it ignores time value of money. All right, you don't calculate the how much is 100 ringgit worth in year two, how much is it worth now. You don't calculate time value of money. So that is a weakness. And the second thing is ignores cash flow occurring after the payback period. All right, so if let's say you recover your money in, like the example I gave earlier, if you recover the money in fifth year, but in sixth year you made 100% profit. So what you ignore how much you're making in the period after your payback. So that's a weakness, right? Because after the payback, all right, after the payback period, you might be earning much more, right? So you never know because you totally ignored those cash flows. So that is a weakness. All right, so the next thing is we have a discounted payback period. All right, so this is developed to tackle the weaknesses in your payback period. So the two weaknesses I mentioned earlier with discounted payback period, all right, it can be tackled. How is it? Especially we're talking about the time value of money here, right? Because previously you have only cash flow, then you calculate the cumulative, right? So 100 minus 10 you get 90, then you minus 60 you get 30, right? But now we're adding present value of the cash flow. All right, so present value already means we are calculating the time value of money. So this is the future value, the money you're going to receive in year one. This is the present value, how much is it worth today. All right, so 10, as we calculated just now, right, for NPV, 10 times discount rate 0.909, you get 9.09, and so on. So you do the same thing, same method, which is cumulative. 100 negative 100 plus 9.09, you get negative 90.91. You still have to recover negative 90.91. And you do that for year 2, you have negative 41.3 to recover, and you only recovered in year 3. So you calculate, it took 2 complete years plus exactly when did you get back the money. So that would be 2.7 years. All right, so that is how long it took for the company to get back the initial investment using discounting, all right, using time value of money. All right, so the problem we had in the payback period, it ignores time value of money. So this method basically incorporates the time value of money. All right,